Today, I want to talk about Ken Griffin's illegal plan to avoid paying for the squeeze. I also want to talk about how these shorts have been digging themselves a deeper hole over the last couple of years, but how that's soon going to come to an end. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Bigham started by tweeting this article of Ken Griffin ready to support DeSantis for president in 2024. And Cat Striker replied by saying of course he is, because Ken Griffin has an agenda to run as Secretary of Treasury under DeSantis. And that's because the Secretary of Treasury has a tax loophole where they don't have to pay capital gains tax. Not only that, but as Treasury Secretary, Ken Griffin would also be able to influence new policy decision making to avoid paying for the squeeze. We learned earlier this year of Ken Griffin's plans to run as Treasury Secretary, but only if the country is in economic trouble and only if DeSantis gets in. And that's because, as this article from 2006 says, Henry Paulson could receive a tax break of at least $48 million if he's confirmed as Treasury Secretary. The article says because of a little known provision in the federal tax code, Mr. Paulson, the departing Goldman Sachs chief executive, could receive a tax break of at least $48 million. The tax rule allows individuals who are forced to sell stock to meet federal conflict of interest rules to defer paying capital gains tax, so long as the proceeds are reinvested in government bonds. So Ken Griffin could effectively close out of all of his long positions in Citadel without paying a single penny of tax. And obviously Ken Griffin would also be able to influence new rulemaking to try and allow the shorts not to be closed out of. Now, while it's pretty much guaranteed that Ken Griffin wouldn't have to pay a penny of tax, it would be very difficult to implement new rules allowing the shorts not to be closed. But then again, considering Ken Griffin already controls the SEC, a number of people at the Fed, and a number of people at the Financial Services Committee, it wouldn't surprise me with what he could have passed. I guess the fortunate thing is that Ken Griffin wouldn't be named as Treasury Secretary until at least sometime in late 2024, if not 2025. And I do believe that especially with what's been going on recently, AMC and GameStop will likely squeeze before then. Because as this tweet shows, it's not just me that's been receiving an increase in FUD comments, it's also billionaires like Bill Pulte. He tweeted saying, as you've seen firsthand, I've been targeted by Fortune 500 executives in an extensive smear campaign to silence, damage and hurt me. Now I've been threatened personally by a supporter of theirs. More on this soon. He said, don't worry, I will be safe, but I just wanted you to know. He also said that he will continue to speak out. He said he's not sure why he's become such a target of theirs, but he thinks that he may have an idea. Obviously, Bill Pulte has purchased tons and tons of GameStop stock and is working very closely with Ryan Cohen. And somebody replied saying, unfortunately, being friends with one of the most hated guys on Wall Street, obviously Ryan Cohen, is going to bring you even more enemies, but keep fighting the good fight. I imagine the reason why Bill Pulte is receiving such an extensive smear campaign is obviously because these shorts very much dislike Ryan Cohen and Adam Aron as well, because the shorts are stuck. The shorts aren't just stuck in AMC, they're also stuck in GameStop as well. They're looking for the escape, but there is no escape. And that's because these hedge funds have been doubling, tripling and quadrupling down on their position over the last couple of years and digging themselves an even deeper and deeper hole. Funny enough, one hedge fund that has been digging themselves a significantly deeper hole is actually Ursa Fund Management. These are the same guys that are currently shorting AMC and have just written to the judge begging for the reverse split to be denied. It says Ursa Fund Management was founded in 2016 and is run by just 2 people, according to LinkedIn. Ursa currently only has $270 million remaining, down from $1.2 billion on the outdated LinkedIn profile that they set up back in 2017. So in just 5 or 5.5 years, Ursa Fund Management has lost just under $1 billion. We can see here on their LinkedIn page, it says Ursa Fund Management LLC is an SEC registered investment advisor with regulatory assets under management of $1.2 billion as of December 31st, 2017. But we can see from their 13F filing, it says their last reported 13F filing for Q1 2023 included just $269 million of assets. Ursa Fund Management has lost tons and tons of cash over the last few years, and it's also interesting to see that their AMC put position is a whopping 21% of their portfolio. When AMC squeezes, it's likely going to end up wiping out the remainder of Ursa Fund Management's cash. Clearly, they've been on a significant losing streak that's only going to get worse. Now we know these shorts have also been digging themselves a deeper hole with this sky-high AMC cost to borrow fee. Before, it used to make zero sense why these banks and smaller hedge funds that were long on AMC were lending out their shares. Before, these funds were only receiving, say, 1% per year on the AMC shares they were lending out. But now, as of late, it actually makes a lot more sense for these hedge funds to lend out those shares because they're likely making even more money than they paid for those shares in the first place. Now, even though it's annoying that these hedge funds are lending out their AMC shares, in some senses it's actually good because it means they're buying up any available shares so those short hedge funds can't get their hands on them. These hedge funds can only continue to borrow and short more and more shares, making their short positions larger. They can't actually buy AMC shares to close out of their short positions, as all of the shares are held by retail investors and other hedge funds that are long on AMC. So if anything, these hedge funds that are long on AMC are just forcing these shorts into an even worse position. Vaughan tweeted saying it's profitable for banks to keep lending out AMC shares and charging outrageous cost to borrow fees, which shorts seem to be only too happy to keep paying, at least for now. The fact these shorts are paying these sky-high cost to borrow fees is just continuing to dig them into a deeper and deeper hole. And that's why when AMC does squeeze, these short hedge funds are going to end up exactly like Ursa Fund Management, losing the vast majority of their portfolio. As Joshua tweeted, he said the shorts have lost because retail investors are not selling their APE or AMC shares for cheap. He said GameStop went to $500 per share on solely FOMO buying and zero short covering before the buy button was removed. Without the buy button being removed, GameStop would have gone significantly higher, and that's still not factoring in the shorts needing to cover. If these shorts did end up being liquidated, GameStop would have easily ran into the thousands, if not tens of thousands of dollars per share. And that was back in 2021, before they continued to naked short for an additional 2 years. Yes, I know AMC hasn't squeezed yet, and I know these shorts obviously don't want there to be a squeeze because they don't want to have to pay billions and billions of dollars, but what I'm saying is that when AMC squeezes, it will squeeze dramatically. The shorts are obviously going to try and do everything they possibly can to avoid a squeeze in its entirety, but if or when they can't avoid a squeeze any longer, AMC will likely run into the thousands, if not tens of thousands of dollars per share. This is because AMC still has all of those synthetic shorts. There's been even more synthetic shorts over the last 2 years, and if shorts are forcibly liquidated, it will be disastrous. And finally, I also wanted to dispel some FUD around Antara's recent disclosed position from Newswire or from Webull News. It says AMC Entertainment shareholder Antara Capital on Tuesday disclosed a 15.4% stake in the movie theatre chain. It says Antara's holdings in AMC total almost 153 million shares. Now, this isn't a new AMC long position, this is just Antara's existing APE long position that's being redisclosed again. If 153 million shares is a 15.4% stake in the company, that means there's just shy of 1 billion shares total. Now, we know that APE has around 980 million shares in existence, and AMC only has 516 million. This is therefore their 15.4% stake in APE, and it's not related to AMC at all. This is again just these news articles or news outlets confusing their data to try and convince us to panic and sell shares. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.